Good afternoon to you. We will begin our lesson for today. Last time we talked about how to value inventory. Today we'll talk about depreciation. This is not the first time we are hearing about depreciation. If we go back, we will find that we talked about depreciation, or we made mention of depreciation when we were talking about amending statement of financial position. And by amending statement of financial position, we did say that there are some things that will cause a statement of financial position to change. Just like there are some things that will cause a statement of profit or loss to change. And we've looked at all these things. And one of the things that will cause a statement of financial position to change is depreciation. So we're going to talk extensively about depreciation today. But let's look at what we said when we talked about amending statement of financial position. We did say that depreciation will cause the value of a non-current asset to reduce. So when the business reduces the value of a non-current asset, we say it has depreciated that non-current asset. By now, we should be familiar with the difference between a current asset and a non-current asset. So only non-current assets are depreciated. Only non-current assets are depreciated. So let me read what it says here. It says the amending balancing action is to reduce the value of reserves and retained earnings and therefore total equity by the same amount. Whenever the value of a non-current asset reduces, the amending or the other transaction is to reduce the value of our reserves. All right, so let's come back to our main topic for today, which is depreciation. So what is depreciation? We do have an idea already. All right, we said a business would want to reduce the value of a non-current asset, but why would it want to do that? We will talk about that later. Depreciation is the reduction in the value of a non-current asset over time. All right, it is the reduction in the value of a non-current asset. So we have a non-current asset such as a vehicle, or we have some computers in our offices, or we have some land or some vehicle, or a building or an equipment, a machine. The value of that machine over a number of years will not be the same. We have to reduce its value. It makes very common sense that if we buy a machine for $60,000, the value of that machine will not be $60,000 after 4 years. Its value will reduce. So the second point here says that a business may engage in revenue and capital expenditure. We saw this in our AS level. We define what a revenue expenditure is and what a capital expenditure is. Now, when a business spends on non-current assets, we say it is a capital expenditure. When a business spends or buys a non-current asset, that spending, that expenditure is referred to as capital expenditure. And when it spends on day-to-day items like fuel, cost of raw materials, the wages of its workers, we say that it is revenue expenditure. So know the difference between capital and revenue expenditure. But the third point makes an interesting point here. It says that only capital expenditure has any relevance to the process of depreciation. What does that mean? It means we only depreciate items that are capital expenditure. We only depreciate non-current assets. We only depreciate non-current assets. All right, so we know what depreciation is. We know that only capital expenditure items are depreciated. The last point here says that a manufacturer may purchase production line equipment and reduce its value as shown in the table below. All right, So this manufacturer is Singapore Components Limited, and it has an equipment which is depreciated annually at 20,000. What do we mean by depreciated annually at 20,000? It means that it reduces the value of that equipment by 20,000 every year. So it purchased the equipment in 2017, and at the end here it says value of the assets on the financial statement of financial position at the end of the year. At the end of the year, it is valued at 60,000 because it has reduced its value by 20,000. So the value at the beginning of the year was 80,000. The value at the end of the year is 60,000. That means that its depreciation is 20,000. By the second year in 2018, the end value of that current non-current asset is 40,000 because it began the year with a value of 60,000 and it has been depreciated by 20,000. So this 20,000 is its depreciation every year, the amount by which the business reduces the value of the non-current assets, which is what depreciation is. By the end of the 4 years, the asset is valued at 0. But why should a business depreciate its assets? Why should a business depreciate its assets? Like I said, it makes common sense that if you purchase, like this business, Singapore Component, if you purchase an asset, an equipment for 80,000, its value will not be 80,000 throughout 4 years or after 5 years. It will reduce in value. Why? Because of things like wear and tear. If I purchase a car today and I start using that car, its value is not going to be the same after a few years. If I want to sell that car off, I'm not going to get the same value like I did when I purchased it initially. All right. So the first point says that it is incorrect to maintain non-current assets to maintain a non-current asset's value throughout its life because it will lose value as a result of wear and tear. That's the first point. Also, there will be newer models of that vehicle. There will be newer models. So if it's a computer, there will be a newer model every year. So a few years ago, Apple launched an M1 MacBook computer. After a year, they launched M2 computer, M3 MacBook. Every year there is a modding version of that equipment, and that will make our old version lose value. All right, because there's a modding one, a new one, which is better in its specifications. Also, because of inadequate maintenance will also cause our assets to lose value. Maintenance will also cause our assets to, or inadequate maintenance will cause our assets to lose value. So poor or adequate maintenance of the assets may mean expensive repairs are necessary, which further reduces its value. If it's not maintained well and you want to sell it off, whoever buys it would have to fix the broken parts, and that would mean that you have to reduce its value before you can sell it. All right, so that's the first reason why we need to depreciate assets, because we want an accurate valuation of that asset. So that's point number one, an accurate valuation, to get an accurate valuation of the asset. So every business depreciates its non-current assets so that the value of that asset reported on its statement of financial position will be accurate. An accurate valuation of the asset would mean that the business is being accurately valued. An accurate valuation of the balance of the non-current asset means that the business is also accurately valued. So let's look at this statement of financial position, which we saw earlier in our previous class. And we have non-current assets here with a value of 7,137. If these non-current assets are not valued properly, it will affect the net assets of the business, and that would also affect the total equity. So the value of the business, which is the value of its assets minus its liabilities, will be affected if the valuation of its non-current assets is not properly done. Assuming the value here is less, it means that our net asset value will be less. Assuming the value here is more than what we have here, it means that we are overvaluing the business, assuming that this value of 7,137 is the correct and actual value. So this is the reason why we need to depreciate our assets, so that we can have an accurate valuation of the asset itself, and secondly, so that we can have an accurate valuation of the business. Then point number 3, we also need to depreciate our non-current assets so that we can calculate the true cost of production. Now, depreciation is an expense which is charged to the statement of profit or loss every year. Depreciation is also an expense. So if we look at this depreciation that is calculated for Singapore Components Limited, this 20,000, which is how much we reduce the value of this non-current asset by every year, this 20,000 is also charged to the statement of profit or loss as an expense. Remember the difference between the statement of profit or loss and the difference between the statement of financial position. The statement of profit or loss is to help the business calculate its profits. So this 20,000 is actually cost to the business. A business will charge this 20,000 to a statement of profit or loss every year as a business expenditure or as a cost to the business. So if depreciation is a cost to the business, that means that if it is calculated, we are able, or if it's charged as an expense to the business, we will be able to calculate the true cost of a business's production, and therefore we will be able to calculate the cost, the profits or the loss of the business accurately. So let's read the third point. It says that depreciation allows firms to calculate the true cost of production during any financial year. By depreciating a non-current asset, a business is able to charge the cost of that asset over several years, as we have seen. Now, a very important point. Charging the cost of the asset in a single year is wrong and will shoot up the cost of the business in that year. So like I said, in the case of this business, Singapore Limited, if all the 80,000 is charged in 2017, that will make the cost in 2017 very high. But the cost of the assets, the cost of the non-current assets, is spread over 4 years, and each year an amount is charged to the statement of profit or loss, thereby avoiding the situation whereby we charge the cost of that asset in a single year. If we do that in a single year, it will create problems and it will shoot up the cost of the business in that year. Note, very important, that depreciation is a non-cash expense. Depreciation is a non-cash expense. So I've already explained that depreciation expense is charged to the statement of profit or loss, which is the first point here, but it is not a cash expense. What do we mean? It means that we do not actually take physical cash to pay anyone for depreciation. It is just an allowance that we make on the statement of profit or loss by charging the cost of an asset over a number of years. So it doesn't actually take cash out of the business. Depreciation actually does not take cash out of the business. The purchase of that asset will take cash out of the business. However, the charge of depreciation does not take cash out of the business. Therefore, we say that depreciation is a non-cash expense. That is, cash is not paid out for depreciation. Then point number 3 to note, it says depreciation allocates the initial cost of an asset over its useful life. So if the useful life of the asset is 4 years, like we see here, then depreciation will be calculated over the 4 years. If the useful life of the asset is 20 years, then depreciation will be calculated or be charged every year for 20 years. All right, how do we calculate depreciation? There are several methods that we use to calculate depreciation, but we will look at just one method of calculating depreciation, which is known as the straight line method of depreciation. The straight line method of calculating depreciation, and this is the formula in the straight line method. Annual depreciation, so depreciation for the year, is equal to the cost of the item, the cost of the non-current assets, minus its residual value divided by its useful life or its working life. So the cost of the machine, in the case of, once again, Singapore, the cost of the machine is 80,000. Its residual value is 0. I would explain what the residual value is, but its residual value is 0, and its useful life is 4 years. So we are charging depreciation for 4 years. So what is residual value? Residual value is the scrap value of the non-current assets. If we purchase an asset today and want to sell it after 10 years, what are we going to sell it for after 10 years? After 10 years, we may want to sell it for 1,000. That is the scrap value. That is the residual value. How much money we're going to take, or how much value we're going to sell that non-current asset for after its useful life is the residual value. All right, so let's read so that I don't miss any point. This is a simple method of depreciation that reduces the value of a non-current asset by the same amount each year until the asset is of no further use or it is sold or scrapped. So the straight line method of calculating depreciation charges the same amount every year because we are dividing it by the number of years. We are dividing the cost of the machine minus its residual value divided by the number of useful years. So I calculated depreciation for my laptop. I purchased the laptop in 2023, and I use a laptop for my business. So I calculate depreciation for my laptop every year or every month. If I purchase a laptop in 2023, I purchased it for 4,000 Saudi Riyal, and I estimate that I'm going to use this laptop for 7 years. After 7 years, I think, now this is an estimation, I'm not too sure, but I think that I may be able to sell it for 500 Riyal because I'm taking good care of it, and I may even get more. I'm taking good care of it, and I estimate that I'll be able to get 500 Riyal for selling off my laptop after 7 years. So how do I calculate depreciation for my laptop using the straight line method of calculating depreciation? The cost of my laptop, which is 4,000, minus the 500 that I think I'll be able to sell it for after 5 years, divided by the number of years that I want to use the machine for. That'll give me the depreciation for the year for my machine, which is 500 Saudi Riyal. So this is the amount or how much I would reduce my laptop by every year. Every year, the laptop would depreciate by 500 Riyal. So most businesses would charge depreciation monthly. So 500 divided by 12, that would be a little over 41 Riyal. So I would divide that 500 by 12 to get the monthly depreciation. But this formula is for us to calculate the annual depreciation of any non-current assets, for example, a laptop, which I use for a business. All right, let's look at the advantage of this straight line method. Number one, it is very simple to calculate and it is easy to understand. I don't think there's anything confusing about this formula and how it is calculated. So yes, it's an advantage in using the straight line method. There are other methods of depreciation that are not quite straightforward. So this is very simple to calculate and easy to understand. And it says the value of a non-current asset can be seen to steadily decline in the business's statement of financial position. So there's a steady decline. Like I said, every year the value of my laptop is reducing by 500. I'm charging this 500 to my statement of profit or loss as a business expense. I'm charging this as an expense to my statement of profit or loss. And I am maintaining the most updated value of my non-current assets on my statement of financial position. So depreciation will be in two places. The effect of depreciation can be seen in two places. Number one, it can be seen on my statement of financial position where the value of the assets is reducing each year by 500 in this case. So in year one, in 2023, I may record the value as 3,500 at the end of 2023. Then at the end of the next year, the value will be 3,000. It will go down steadily until I decide to sell it off. So number one is very simple, and we can see a steady decline in the value of my assets on the statement of financial position. Number two, another advantage is that it spreads the cost. It spreads the cost of the assets over its useful life or over its working life, which is important if a business is to have an accurate view of its financial performance. It spreads the cost of that asset over its useful life, which is important if the business wants to have an accurate view of its financial performance. Charging the 4,000 cost of the laptop in a single year, 2023, would not give an accurate view of the financial performance of the business, because it will reduce the profit of the business drastically in that year. But if we spread the cost of the 4,000 over a number of years, then it gives an accurate view of the financial performance, because I'm going to use the machine for a number of years, not only in the first year. But there's a disadvantage. The first one says that few assets lose their value steadily over a period of time. Yes, that's true. So if I purchase an asset today, say for the same laptop, it is common that the asset will lose value more heavily in its earlier life, right? It is common that the assets may lose value more quickly in its earlier life. Why? Because it's brand new, its performance is top notch. Same for a car, it's brand new, its performance is great, and we might exert a lot of pressure in using it, and therefore its value may decline in the earlier stage of its life than in the latter stage, when we begin to repair it and is able to perform also for those years. But in the first year, it might lose a lot of value. So it's not as straightforward as the calculation makes it look, because not every asset would decline steadily in value in the way that the straight line method paints the picture. All right. Then the second point here says that thus the straight line method may overvalue a non-current asset in the earlier years of its life. Yes, that's the point I made. This is particularly true of vehicles and other technology products. All right, so these are the advantages and the major disadvantage of the straight line method of depreciation. Why is depreciation important? Why must a business calculate depreciation? Why is depreciation important? Number one, depreciation is important because it provides an accurate value of the business's assets, so that the laptop is not valued at 4,000 every year. If 4,000 is reported on the statement of financial position every year, it means the laptop is not losing any value. That's not accurate. But if we depreciate the assets, then it paints an accurate picture of the value of the business's assets throughout its life. So it says it allows for a true and fair assessment of the overall worth of the business at a time. Yes. So that at any given time, when our investors, when the government, when any user of our financial statement takes a look at the financial statement, they know that they are given a very true and fair value of the business because its assets are well depreciated, properly depreciated. And that's the point that it makes here, that having an accurate figure for the overall value of the business is important for stakeholders such as investors and creditors. And then number two, why is depreciation important? Because it affects the calculation of profits. Remember, I said that the value of depreciation is charged to the statement of profit or loss. And I use this example, this 20,000 example for Singapore components. That 20,000 is charged to a statement of profit or loss every year. If that is not done, it means that we are not accurately representing the performance of the business. If that is not done, we are not accurately reporting on the true performance of the business. All right, let's look at this point in this table. The same point we are looking at. Why is depreciation important? Let's look at this table. In the case where there is too much depreciation, and in the case where there is too little depreciation, it means that depreciation is not calculated accurately here, so it is being underestimated. It's too little, and then here depreciation is being estimated, so too much of it is charged. What does it mean? What effect does it have on a statement of financial position, and what effect does it have on a statement of profit or loss, and what is the general effect? So let's take a look at the statement of financial position first. If too much depreciation is calculated or charged, or depreciation is overvalued, it means that our assets are valued at less than their true worth because we are calculating too much depreciation. For instance, let me go back to the laptop example. If I charge, instead of charging 500 depreciation, I'm charging 1,000 depreciation. That means that I'm estimating the value of the laptop on my statement of financial position, because instead of reporting it at 3,500 at the end of the first year, I'll report it at 3,000 at the end of the first year. So that means that my non-current assets are valued at less their true worth if I charge too much depreciation. On the other hand, if I charge too little depreciation, it means that the non-current assets are being overvalued, and it gives a false sense of the company's worth. Here, it means that we are underestimating the worth of the business. Here, it means we are overestimating the value of the business. All right, so that's the effect of charging too much depreciation and too little depreciation on the statement of financial position. Let's look at the statement of profit or loss. Remember, we said depreciation is an expense on the statement of profit or loss. So if we charge too much of it, that means that we are reducing our profits. If we overestimate depreciation on the statement of profit or loss, it means that we are reducing our profits. And if we underestimate depreciation on the statement of profit or loss, it means that we are overstating our profit. It means our profits are being higher than they would otherwise be. So the wider effect is that when a business charges too much depreciation, overestimates depreciation, it makes the business unattractive to prospective investors, because the true worth or value of your business is not being reported. The true worth or value of your business is not being reported. And then the wider effect of charging too little depreciation here is that it makes the company more attractive to investors, but also increases its tax liability. If there is too little depreciation, it makes the company more attractive to investors because we are overvaluing the business. It has more value than it actually is. So it makes it more attractive. But then On the statement of financial, on the statement of profit or loss, we are going to pay more tax because our profit is going to also be overestimated. Our profit will be higher, and therefore we'll pay more tax. Here, the government will come for us. Tax authorities would investigate if we charge too much depreciation, because they would detect that these people are being smart. They are over, because depreciation is a non-cash expense. The business is charging too much depreciation so that their tax liability will be reduced, and the government will not be happy. The tax authorities will come for us if we do that. All right, there's a case study here that we have to look at, but that will take a lot of our time, so let's go straight to this slide. All right, so let's look at the relationship between statement of financial position and the statement of profit or loss. Remember, I said that in one of our case studies, we said that it's not best practice to analyze the performance of a business using just one statement, using just the statement of financial position, or using just the statement of profit or loss. It is important that we put all the statements before us and then truly analyze the business with all the statements, the two statements together, the two statements that we are looking at in this our syllabus. Like I said, there are other financial statements, statement of cash flow, statement of owner's equity, but we are not looking at that. We are looking at only statement of financial position and statement of profit or loss. But let's look at the relationship between them, because there are some items on each, or on both, or there are some items on one statement that features also in the other statement. One of them is profits, dividend, and retained earnings. All right, profits, dividend, and retained earnings. So retained earnings are profits that are not paid as dividends. So that is on the statement of profit or loss. However, retained earnings is also reported on the balance sheet. It's also reported on the statement of financial position. So let me see if I can find an example. I don't think there's an example here. All right, so yes, there is an example here. So this statement of financial position is reporting reserves and retained earnings for 3,081. This figure is taken from the statement of profit or loss for the year. If there are profits for the year that are undistributed to shareholders, this figure comes from the statement of profit or loss. So this figure from the statement of profit or loss is also presented on the statement of financial position in the equity section of the statement of financial position. So that's the relationship between this item, reserves or retained earnings. That's a relationship between returns and retained earnings, between statement of financial position and statement of profits and loss. All right, let me come back. Yes. So we are looking at the relationship between statement of financial position and statement of profit or loss. And the first one that we said is that we can find some items on the statement of financial position and also on the statement of profit or loss. And one of them is profits, dividend, and retained earnings. So when profits are undistributed or paid out as dividends, they are reported on the statement of financial position as retained earnings. And then the second one, short-term borrowings. Short-term borrowings are current liabilities. They are not non-current liabilities. They are current liabilities. So short-term borrowings are reported as current liabilities on the statement of financial position, but when the payments are made for the loans, when the payments are made for the loans, those payments are recorded as expenses on the statement of profit or loss. So there are non-current liabilities on the statement of financial position, but there are expenses on the statement of profit or loss. So that's how the statement of financial position and statement of profit or loss are also linked, related in terms of short-term borrowings. And also depreciation, we've already looked at depreciation. And an asset is depreciated every year and its value will be reduced on the statement of profit or loss. However, it is also recorded as an expense on the statement of profit or loss. It is its value, it will be reduced on the statement of financial position rather, but that same reduction in value is recorded as an expense on the statement of profit or loss. And then the last time we looked at inventories and then how to value inventories. So the method that we use to value inventory will help determine the business's cost of sales and therefore its profit. So inventory will be reported on a statement of financial position as current assets. Inventory will be reported on the statement of financial position as current assets, but also will be reported on the statement of profit or loss because its value will help determine the value of cost of sales. And if this were an accounting class, we would have gone deeper into that, but we will not go deeper into that. We just have to know how cost of sales are calculated. Cost of sales is calculated by starting with opening inventory. That's the inventory we have at the beginning of the trading period for a business. Then we add any inventory that we purchased, and then we subtract closing inventory, and that will give us the cost of sales. That will give us our cost of sales. So let me break it down. We sell bottles of water. Our inventory is either raw materials, work in progress, or finished goods. But let's work with only finished goods for the purpose of this explanation. We sold 1 million bottles. But what does it cost? What did it cost? What's the cost of the 1 million bottles that we sold? Each bottle is sold at $1, like I always say, one bottle $1. So our revenue is $1 million. But what did it cost to produce each unit of bottle? That is what we call cost of sales. And cost of sales is calculated by, did we have any inventory from the previous year? If we did we purchase any new inventory? If we did, let's add the purchases of inventory to our opening inventory and then subtract what we have not sold, which is closing inventory. And that will give us our cost of sales. And then we subtract our cost of sales from our revenue to calculate our profits. So inventory is also another item that links the statement of financial position and the statement of profit or loss. So the first point here says that the value of closing inventory depends on how inventory is valued on the statement of financial position as current assets. The value of closing inventory or the value of inventory is valued on the statement of financial position. How closing inventory is valued in the financial position. And we saw how inventory is valued. That is either the less of cost or net realizable value. We saw that in our last lesson, how to calculate the value of inventory. So that calculation is going to affect the calculation of our cost of sales. All right. The second point here says the lower the value of closing inventory, the higher the cost of sales, which results in lower profits. So the lower the value of the closing inventory, that calculation that we use our net realizable value to calculate, if the value is lower, that means that our cost of sales will be low, which will result in our cost of sales will be high, which will result in lower profits. And then the last point here says that a higher closing inventory valuation results in lower cost of sales and higher profits. So the important point that we are trying to establish here is that the valuation of inventory on our balance sheet, on our statement of financial position, will determine how much our profit will be on the statement of profit or loss, further explaining the relationship that is between the statement of financial position and the statement of profit or loss. So we've looked at a couple of them, not only inventory, profits, dividends, and retained earnings, borrowings, depreciation, and then inventory. And then we looked further at how inventory is calculated, how the value of inventory is calculated, how the value of cost of sales actually is calculated, and how inventory valuation affects this cost of sales. So let's look lastly at this diagram, and then we'll bring our class to a close. So we are looking at depreciation, and we say that depreciation affects the statement of financial position, and it also affects the statement of profit or loss. It's on the statement of profit or loss as an expense, where the value that is calculated for depreciation, or how much the asset is reduced by, the value by which the asset is reduced, is also charged as an expense on the statement of profit or loss. And then that value is also reduces the value of our non-current assets on the balance sheet. So let me read so that I make sure I don't leave any point unexplained. So it says the value of many non-current assets is reduced over time, and their current values are recorded each year on the statement of financial position. Yeah, precisely. And then on the statement of profit or loss, it says that the amount by which the value of non-current assets is reduced annually is shown as an expense, like I said, on the statement of financial position. All right, so basically, this is the this is the straight line method of calculating depreciation and what depreciation is all about. And I hope that it was straightforward and simple to understand. There was no time for the case study. We don't have enough time. We just have, because of your schedule today, we cannot look at the case study today. We'll look at that next time. And also look at the data response question on page 443 of your textbook. So essentially, this brings our unit 10.1 to an end. So let's go back here. So unit 10.1, statement of financial statement. We've looked at statement of profit or loss. We've looked at statement of financial position, and then last time we looked at inventory valuation, and today we've looked at depreciation. All right. If you have any questions in your reading, you can just send it to me, and then I'll do my best to answer it. But from on Thursday, we'll look at something new. No, on Thursday, we'll go through the case studies before we look at something new, because the case studies make an important point that we have to look at. So we'll look at the case studies and we'll look at the data response question before our next class, which will take us to analysis of published accounts. If there are no further questions, I want to bring the class to a close here now so that you can attend to your other business. Any questions?
No questions.
All right.